Howdy, everybody. Welcome to Liberty Call. Today is Friday, June 27th, 2025. Hope you're having a fantastical day out there in the interwebs. It is, well, we got clouds coming in. It was sunny a little while ago. So, anyways, hope you're having a fantastical Friday. We're headed into the weekend, which is awesome news. And, well, let's dive into what's going on in the world. Wall Street wrapped up the week with fresh record highs as AI optimism, easing Fed rhetoric, and calmer geopolitical headlines powered the rally. The S&P 500 hit 6178, NASDAQ crossed 299, and Treasury yields drifted lower. NVIDIA and Micron led tech gains while traders shrugged off recession chatter for now. But with markets stretched and summer just heating up, complacency could be costly. So before we break all the news down, I need some help from you. If you could give me some thumbs up, I'd like to share, subscribe, or follow, and press that notification bell. All right, let's get into the markets. Dow Jones was up 1%, 432 points, closed at 43,819. S&P 500 up 0.47%, 28 points, closed at 6169. NASDAQ up 0.52%, 105 points, closed at 20,273. The VIX was down 1.63% today. It's at 1632. Canada down 0.22, Brazil down 0.2, and Mexico down 0.19. Headed over to Europe, Germany was up 1.48%, the UK up 0.72%, France up 1.78%, Netherlands up 1.04%, Spain up 1.11%, Italy up 0.99%, Switzerland up 0.83%, and Portugal up 1.24%. Russian exchanges were split today. The MOEX up 0.3%, RTSI down 0.03%, and the overnight markets, the Nikkei in Japan was up 1.43%. Australia down 0.43%, New Zealand up 0.77%. In China, the Shanghai down 0.7%, Shenzhen Component up 0.34%, China A50 down 1.3%, DJ Shanghai down 0.48%, Hang Seng down 0.17%, and the Taiwan weighted up 0.61%. All right, good stuff. Good stuff. All right, well, let's jump to, before we do that, let's get to the check out the markets and how they did for the week. Getting ahead of myself here. There we are. Go to the weekly chart, take off the lines, and all right. So starting out with the Dow Jones, looks like we're going to be up about 3.77% for the week. The S&P 500 is going to be up about 3.08%. The NASDAQ up 4.02%. The Dow Transports up 4.99%. And the utilities are up about 0.95%. So that's the least of these five that are my standard indexes here on my chart. So all in all, not too bad. If we zoom out, take a look and see how things have done for the year. So we had a nice little upswing in January. Then we had 3 months of a downtrend here in the Dow. Broke the trend in early May, and we've been kind of sideways for about 2 months, and a little bit of an uptrend here the last couple days. But we'll see what happens. Again, until we really see any deterioration in the consumer spending, and then my expectation would be next the jobs numbers. Probably not any major black swans yet to occur here in the stock market. So, but we can see, things can happen very, very fast. All right, well, let's get to the data that came out this week. Initial jobless claims came in at 236. Forecast was 244,000. Previous was 246. Continuing claims came in at 1.974 million. Forecast was 1.95. Previous number 1.937. The S&P Global Composite Purchasing Managers Index came in at 52.8. Forecast was 52.2. Previous 53. Existing home sales came in at an annualized rate of 4.03 million. Forecast was 3.96, and the previous number was 4 flat. Existing home sales month over month was up 0.8. The forecast was a contraction of 1.3%, and last month was a contraction of 0.5%. House price index came in at average home price is 434,900. Previous number was 436.7. And let's see, on the month House price index grew by 3%. Previous number was 3.9. And house price index month over. Oh, that was year over year. Oh, that's the price. That's the annual. God, I'm an idiot. And then the month over month contracted by 0.4. Forecast was a 10th growth, and previous number was flat at 0. Get my charts mixed up. The consumer confidence index came in at 93. Forecast was 99.4. Previous number was 98.4. So bit of a downtrend looks for a month, and we're off the forecast. New home sales annualized at 623,000. Forecast 694. Previous number was 722. And on a new home sale, month over month contracted at 13.7%. Last month, it grew by 9.6. So if you look at this chart, it's just like back and forth, back and forth, back and forth. GDP for the first quarter was revised down to negative 0.5%. Forecast was negative 0.2. Previous number for the fourth quarter last year was 2.4%. Retail inventories, excluding autos, came in were down 0.2%. The previous number was up 0.3. And month over month, that was down by 0.3, and the forecast was up 0.2. Goods trades balance came in for this month for the June release at negative 96.59 billion for the trade deficit, and the forecast was negative 86.3, so much worse than the forecast. Previous number was negative 86.97. Durable goods orders month over month grew by 16.4%. Forecast was 8.6. Previous number was a 6.6% contraction. And pending home sales month over month grew at 1.8%. Forecast was 0.2. Previous number was a contraction of negative or 6.3%. So, and again, kind of like the other one, the other home chart, just back and forth, back and forth. The PCE price index year over year, that's the personal consumption and expenditures index, grew at 2.3%. Forecast was also 2.3. Previous number was 2.2%. And the PCE price index for the month came in at 0.1. Forecast was 0.1, and same with the previous. And then last but not least, the Michigan consumer sentiment came in at 60.7. Forecast was 60.5, and previous number was 52.2. So big jump from where it had been for a number of months, and then boop, jumped up there. So, all right. So that is the data for the week. Very exciting stuff. All right. Let's get into the market recap and go from there. The S&P 500 gave up gains Friday after hitting fresh record highs as President Trump reignited fears of a trade war by abruptly ending trade negotiations with Canada. I don't think Canada's going to go to war with us. The fallout came after Ottawa opposed a digital services tax targeting U.S. tech giants, prompting Trump to accuse Canada of copying Europe's egregious tax policies. The announcement overshadowed earlier optimism surrounding U.S.-China trade relations, where Treasury Secretary Scott Bessent confirmed progress in resolving key issues over rare earth mineral shipments. China's Ministry of Commerce echoed the positive sentiment, fueling hopes that a trade deal can be finalized before the July 9th deadline, when reciprocal tariffs are set to resume. Market sentiment was also bolstered by a ceasefire between Israel and Iran, and hints from the White House that Trump may extend the 90-day tariff pause. Meanwhile, inflation data showed mixed signals. The Fed's preferred inflation gauge, the core PCE index, rose slightly more than expected at 2.7% annually, keeping markets focused on how tariffs may affect future price gains. Analysts noted that without tariff risks, the Fed would likely already be cutting rates. Well, I'm not so certain about that. I mean, I really personally don't see any warrant for lowering rates. I mean, inflation is still above 2%, which they claim is their target. And, it's not like we have any sort of, a negative stock market or, the job market really starting to stumble. So until those things happen, I'm really not too quick to point to the Fed and say, see, y'all should be doing something. So, I mean, personally, in my opinion, the Fed should just sit back and fold their arms and just let the economy do its thing. Let's see here. On the corporate front, Nike shares jumped after the retailer reported better than expected quarterly results and outlined plans to shift more production to the U.S. to mitigate potential tariff costs. Investors also await results from the Fed's annual bank stress tests, with analysts expecting large banks to comfortably pass, paving the way for shareholder returns. Despite Friday's volatility, Wall Street is still on track for solid weekly gains, though trade uncertainty continues to weigh on the outlook. Okay. All right. Next up, got data report here. The May personal income and consumption report from First Trust. Mr. Andrew Opdyke put this together. U.S. incomes and spending unexpectedly declined in May, though the underlying details were more mixed than the headline numbers suggested. Personal income fell 0.4%, worse than expected, with previous month's data also revised lower. However, private sector wages and salaries actually rose by 0.4%, offset by declines in government transfer payments and farm income. The drop in transfer payments was largely a reversal of temporary one-time boosts from the Social Security Fairness Act and Emergency Commodity Assistance Program, both enacted under the prior administration. These declines are seen as a return to normal rather than a worrying long-term trend. Personal consumption also declined, falling 0.1%, driven by a 0.8% drop in goods spending, while services rose 0.1%. Most of the goods spending decline came from motor vehicles and parts, reflecting a pullback after consumers rushed to buy before the tariffs took effect. Lower gasoline prices also contributed to weaker energy goods spending. Within services, spending on housing, utilities, and healthcare saw modest gains. Inflation data showed PCE prices rising 1/10 in May, with the annual rate ticking up to 2.3%. Core PCE, excluding food and energy, rose 0.2% month over month and 2.7% year over year. While inflation remains modest, recent price increases could push year over year readings higher due to soft comparisons from 2024, and also increasing the money supply. That has something to do with it. The Fed is expected to remain cautious at its July meeting, wary of tariff impacts and policy uncertainty. However, rate cuts are likely later in 2025. Meanwhile, pending home sales rose by 1.8% in May, suggesting a slight dip in June existing home sales. Factory sentiment also improved slightly, with the Kansas City Fed Manufacturing Index rising to a -2 in June from a -3. Still in the negative. All right. And we got one more article here to cover before we get to our weekend. Comes from Zero Hedge. GOP kills the revenge tax in Trump's Megabill. Wall Street breathes easy. So let's see what that has to do with. All right. Wall Street analysts and investors breathe a sigh of relief following the Trump administration's decision to remove the controversial Section 899 revenge tax from its massive One Big Beautiful Bill. The proposed tax aimed to penalize foreign countries imposing digital services taxes on U.S. tech firms, a key component of Trump's economic nationalism agenda. Its removal followed productive discussions with G7 leaders, which U.S. Treasury Secretary Scott Bessent said helped defend American interests and preserve tax sovereignty. The decision comes as part of a broader agreement with G7 partners to exempt U.S. companies from certain foreign taxes and to implement the understanding within the OECD Global Tax Framework. Senate Finance Committee Chairman Mike Crapo, that's funny, a senator whose last name is Crapo. That is, it fits if the shoe fits. And House Ways and Means Committee Jason Smith confirmed the removal of Section 899, citing the deal with G7 nations. Analysts from TD Securities, Deutsche Bank, and Goldman Sachs described the move as market-friendly, with some warning that if other countries fail to uphold the agreement, retaliatory measures could still be taken under existing U.S. law. Despite progress on Section 899, the overall fiscal package still faces uncertainty. The Senate aims to pass the bill by the July 4th holiday, but unresolved issues, particularly technical hurdles with Medicaid reforms, could push final package into July or August. The bill's removal of Section 899, however, is seen as a positive step that reduces investor anxiety over escalating trade tensions, particularly with key allies like Canada and European nations. Well, as far as the Medicare reform, or Medicare, Medicaid, what was it? What did I say? Medicaid. It's my opinion, and again, this comes from a libertarian view of things, is that the federal government shouldn't be involved in healthcare at all. I mean, it's not within their jurisdiction. So I mean, the fact that we're arguing over who should or should not get Medicaid, it's not a federal issue. Now, if states want to have a Medicaid program, that's fine. States can do anything they want as long as they're not prohibited by the Constitution, and it's not a function that the federal government already does, which are only three things: defense, commerce, and diplomacy. That is all. So I don't know where they use the general welfare clause as an excuse, or the commerce clause, to shove in any new agencies or things that they want to do. But in reality, it's unconstitutional. And eventually, we're going to have enough Thomas Masseys in the government that are going to be like, this stuff's not legal. We need to get rid of it. So, all right. Well, that is everything that I wanted to ramble on about today. If anyone needs to get in touch with me to do some financial planning, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'll be glad to help. All right. Well, I hope everyone out there has a wonderful evening and a great weekend. And I'm going to watch baseball, do some chores, hang out with my lovely wife and my doggies. And that's about it. So hope everyone out there has a good time. And I'll talk to everyone next time. Adios.